These equities, I think, are putting in sometime this year, are putting in a 44-year secular top, at much higher levels than here, but 44-year top is a big top. And whereas silver and gold, I think, they could top out this year for this cycle, but next cycle they'll go much higher. I have a 20,000 target for gold by the, say, 2032 or 3, and 1,000 target for silver. So the tops this year are cyclical tops. The top this year in equities is a secular top. Very different.
Now, how are you measuring this? Because I know we've had you on in the past, and where it has looked like, well, maybe the bubble's popping, and you're saying, no, this is likely the bottom, and we're heading up from here. And sure enough, within a few weeks or what, we turned around and headed up. So how are you, I guess, calling this? And when we do see a final melt up phase, as you've been calling for, what are going to be the indicators for you to say that this is actually, we're nearing a top at this point?
Sure. I mean, there's always a risk that I'm wrong. I'm a human being making a call. So even though I've had a pretty good track record here for the last 5 or 6, 7 years and before, but that in particular, it doesn't mean I'm always going to be right. So people have to understand it is my forecast. It's not a given. But I'm a contrarian. A lot of my work is based on sentiment, and sentiment, it just keeps. Every time we get up there, there's something that causes the investor to get nervous, and that wall of worry just gets rebuilt so quickly. And so right now, it still looks, both technically and from a sentiment perspective and fundamentally, like there's more to go. And particularly what I like a lot when I'm talking about equities is how we have these groups that lagged for so long, financials and materials, small caps, have caught up this year or are acting better this year, and their charts are wonderful. I mean, they have a lot of upside ahead. So even if you're nervous about AI and semis because of how far they've come and how sharp the correction is, the overall market still looks like there's plenty there to be positive about. And then, like I said, I don't think you're going to top out on either AI or semis before the top of the market. They've been the leadership the whole cycle. I think they will continue to be the leadership up into the top, meaning they'll go to higher highs. I think, however, the financials, materials, small caps, maybe even biotech, those kind of things, I think will outperform in this last run, maybe. Although now that semis have corrected as much as they have, it may not be an outperformance from there. It'd be an outperformance from where they were at the highs. But so I, all of that tells me, because of the sentiment, that there's still that next leg up, or that last run to the top that's steep. If you do the numbers, I haven't done them recently, but before we corrected, it looked like we had another 30 to 35, 40% left to go to the top. Now that we've corrected in some of those groups, it's more probably over 40% in the tech area. So there's plenty of upside still ahead, I think. And because of sentiment being so muted, basically so many people being skeptical, particularly institutions, that is fuel for the run, because when institutions or any investor, when they're bearish, they've already acted on that bearishness generally, and that means there's fuel. When they decide they have to get back in because they're wrong, that's fuel for the next advance. In terms of what I'll look for at the top, because sentiment is so important, and because I'm a contrarian, because typically at bottoms, most people are bearish, or the most bearishness is at bottoms. At tops is when you see the most bullishness. So I'll be looking for that sign that everybody is all in. There'll be a narrative that's very bullish, telling you there's years to run. They'll have a fundamental narrative that will go along with that. People tell you the technicals look great. It's when you hear that across the board that you should start getting nervous. Doesn't mean that's the exact top, but it means it's probably time to start scaling out or at least being aware that this thing could end at any time. We're not there at all right now.
As we enter this final melt up and bust phase, how do you anticipate the Fed reacting to that? I know in the past, I think this may have been a conversation we had about a year ago, you were expecting the base money supply to increase during the bust for the Fed to, kind of bail everything out. It increased to about 20 trillion. What is your current view on where the base money supply could go and how the Fed is going to be reacting to the bust?
Yeah, so I want to preface it by saying all the stuff I just said about Kevin Warsh is correct in theory, but unfortunately, I fear we are heading for a global bust that's going to change. It's going to force his hand and force anybody who would be in that position's hand. And so I still believe we're heading for a global bust. It keeps getting pushed out because the cycles remain strong. But I thought there's signs under the surface that say next year could be a rough year globally. And certainly the oil situation exacerbates it, whether we're mostly behind us or not. If it isn't, that certainly will exacerbate it. But I think there are signs of a global bust being here next year. If that's the case, ultimately, a bust is something I'll define just very simply as worse than 2008-9. There's more to it than that, but and it means that you'll have, because of the massive leverage in the system, you'll have a massive unwind. Leverage, once you start heading into a recession, things start rolling downhill, that leverage really kicks in and causes financial crisis. So I think that's what we could see next year, and if we do, it's going to force the Fed's hand. It's not going to be steady as she goes. It's going to be, we need to do it. My concern is because of what happened in 2008-9, because of the pandemic in 2020-21, where we printed a lot of money, we expanded money supply big time and expanded the debt big time. My fear is, because it's everybody said it, Powell said it, Warsh has in one way or another said it, they don't want to go back there. Warsh wants to shrink the balance sheet, which is probably 6.7 trillion now, down from 9. He wants it back to a normalized place where it might be 2, 3, 4 trillion maybe. It was 875 billion going into the 2008 crisis, in October 2008. So we've gone from 875 billion to 9 trillion back to 6.7. I'm saying you could get to 30 trillion because a bust is going to require it. But, Powell said we don't want to ever go back there. That was very bad policy. We want to normalize the balance sheet. We don't want to do zero interest rate policy again. We don't want to just print money willy-nilly or QE infinity. I think Warsh is in the same boat. So that's where their head is at. But it's a very different story when you're faced with a free-falling financial system worldwide, and the only solution you have is money. And it takes time to get that money to a level, what I call a right-size policy, that stabilizes things and turns it back up. They're going to be early on in let's say, a recession, and then what's moving towards a bust. They're going to be reluctant to do what in past times we would have done, because they're fighting that war that the last war of 2008-9 or 2020. And so they're going to be slower to react, not quicker. They're going to be, and if we're looking at, if I'm right, this global bust is going to be bigger than 2008-9. That means you should need a bigger response than either 2008-9 or 2020. And in fact, they're going to be wanting to do much less. That means there's going to be a period of time, probably months, where they're going to be behind the 8 ball and slow to respond. They'll be putting money in. They just won't be putting in nearly enough to stabilize things. And then they'll, a month later, they'll say, well, we got to do more. and they'll do some more, and then they'll do some more. So it's going to take many, many months, I think, to get to a right size policy. And in the meantime, things are going to be heading south in a hurry. So that's my fear. Whether it all plays out that way or not, we'll see. But my viewpoint hasn't changed at all. And yet, I mean, you heard me sing the praises of Kevin Warsh. It's not really, it's circumstances. It's where we are in the big picture. It's where we are in what I call a super cycle. We've just levered up the system cycle after cycle after cycle, going back to the Great Depression from World War II on. And each successive cycle, pretty much, we've gotten more levered and more extreme in terms of imbalances and what it takes to crank it down because of inflation or what have you. Now you're in a place where it's a very fragile system, partly because of the pandemic, partly because of all the leverage, and a very leveraged system. And yet you've got policymakers thinking in less extreme ways. They're just, so they'll get there. They'll be forced to get there. It's just a question of at what breaking point do they get there? How far down do we go before they really all of a sudden, have deer in the headlights eyes and go, we got to speed this up. We got to get a lot more in there than we've been doing. It's hard to predict, but in the meantime, you could have a pretty big bear market and then lots of casualties in the financial industry as they wrestle with what to do. I believe the bond market is in a bottoming phase here. It's been a 2 3/4 year bottom. That's a big bottom. It's been skating along that level for all that time. Obviously, the 10-year got up to 5% a year ago or more, and it's come down from there. But it's backed up from 4% back to 460, almost 470, and I think that's pretty much the high water mark. If I'll be surprised if it's not, and I think we start rolling over here very soon. Maybe starting with the policy today. Not that the Fed's driving it; it's more comfort that the Fed's not raising rates. But it'll start slowly, but ultimately, I think because of a global bust next year, you could have the 10-year get down to 0%. As crazy as that sounds, because at the point where the Fed finally jumps in a big way, the way you create QE is by buying treasuries from the treasury bonds from the banks. They're going to be buying every bond they can get their hands on if we're going to be putting 20 trillion into the system. So rates, I think, are at a high water mark here. You've got a lot of people out there. I'm pretty contrary on this right now, but you got a lot of people out there in the bond market, among strategists, talking about higher rates. In some cases, much higher rates from here. I'm the opposite. I think we are at the high water mark and we'll head down ultimately to 0, but in the meantime, it'll find its way to 4% on the 10-year and then 3%. And then from there, once the Fed kicks in with all the monetary policy, the monetization of bonds, you'll see it run pretty quickly, I think, from 3 down to 0, meaning over a course of 6 or 8 or 9 months. So I just wanted to get that in there because we hadn't talked much about rates.